We had some seemingly tectonic shifts in the market. We've gone from above 5 to about 4.6 in 3 days. That is not supposed to happen. What a wild end of the week, man.
I think it's going to actually be going lower. Yes, we are crashing up.
I don't know about you folks, but I have been looking forward to this conversation all weekend. We had some seemingly tectonic shifts in the market. We had a Jerome Powell who was more dovish than many expected. We obviously did not get a rate increase. The market now thinking the Fed is done. We have some earnings coming out that have been maybe better than expected. And we have a 10-year note that has had a 4 sigma event, according to Danielle DiMartino Booth. We've gone from above 5 to about 4.6 in 3 days. That is not supposed to happen. We're going to talk to Mr. Dan Bird about everything. What a wild end of the week, man.
Yeah. I mean, I did a midweek update Wednesday.
You did.
And I said in that midweek update that I was looking at 4.5 on the 10-year.
Almost got it. I think what did it end at, like 4.54 or something like that? It was
something like that. We'll look at it. But I mean, I think it's going to actually be going lower.
Oh, yeah. I don't know if there was an interview I did with the Fed guy, Joseph Wang, a really known Fed insider and economist, and he scared the bejesus out of me talking about a scenario he called the crash up.
Yeah.
And basically what leads that is lower rates.
Mm-hmm. And, crash up in the stock market?
All assets, stock market, real estate.
Yeah. Well, yeah, but this is not surprising. This is not a shocking statement. Or it shouldn't be.
You say that so easily. I would think most people would call a crash up scenario shocking, but that's just me.
I don't know. Well, we'll look at some things. I mean, I've been on your channel now almost 2 years.
No, let's be clear. Your opinion hasn't changed, and I applaud you for that. I think most people, for the first year, were like, who is this guy? That's cute. I think the last 6 months, people are like, damn, this guy knows what he's talking about. He's been right. I don't know what your batting average is, but it's got to be 700 plus.
I don't know. I don't keep track of that.
But no, I mean, you've got receipts. We got 2 years of videos.
Yeah,
I don't delete them, so go watch them.
Yeah, they're all out there.
They're all out.
I mean, I've talked about from the very beginning. I've talked about the secular bull market that lasts 20 years. We are still in a secular bull market.
Okay, Dan, I'm hearing you finally.
We've got at least 6 more years left. Yes, we are crashing up.
All right. So tell us what happened last week. What had happened in your opinion?
Well,
Wednesday update.
First off, interestingly, a comment that I saw from one thing that I kind of follow is, yes, the Fed did not raise.
Mm-hmm.
They held steady. The jobs numbers came out weak. Mm-hmm. Weaker than expected, should say. They weren't actually weak, but they were weaker than expected.
Weaker than expected, yeah.
Right. But under the covers, that I'm not sure anybody noticed too much, is they had a downward revision for 2 months. They've actually had 9 months in a row, and every month in 2023, downward revisions.
To the jobs number?
Yeah.
Yeah. No, I've seen that. Yeah.
In the rearview mirror, going backwards.
Mm-hmm.
So while the number looks great when it first comes out, they continually downgrade it, which doesn't get much attention, right?
Yeah. The revisions are not headlines, correct?
Right. But 9 months in a row. I mean, what usually happens after 9 months? You have a baby, right?
Yeah. So okay.
Do we have a recession coming?
Yeah, no, I've called one, right? I called one Q1, Q2. I don't know if you also saw it on Friday, but I believe you brought this up 6 months ago. I think you said this. If you didn't, correct me. But you were looking at the unemployment rate if it ever went up 5 or 0.5%.
Yes, that's right.
And it just did.
Yeah. Well, not quite. It went 0.4.
No.
Well,
no, it was 3.4 to 3.9. That's 5.
Yeah, that's right. That's half. That's half. Yep, that's right.
So
we'll look at that. We'll look at that too.
Yeah. So there's Danielle DiMartino Booth, to her credit, called that out. I think it's called the ROM rule. I know I hadn't heard of it before.
I don't know what the rule is. I just noticed it on the charts.
Yeah, no. So that was significant. That's something else that came out Friday. Also, ISM, the ISM number, not many people talked about. It was super weak. So, and then lastly, GDP Now, which gets all the credit for calling the gangbuster Q3, right? It was way ahead of the experts and right. It had a huge revision down last week for Q4. It went from 2.3 to 1.4. So it seems we seem to be hitting the wall that I saw coming. And
so the Fed is working. So the Fed's job is done.
Well, again, I've been calling that for quite a while. I said we were at the terminal rate. So we'll, I think there's a lot of people that finally think the Fed's done.
Yeah. Yeah. So I think the Fed's done. I mean, I've thought that for a while now. I wasn't surprised they didn't raise. I don't think they're going to raise again. I think they're going to start cutting.
Oh, no chance.
People think.
Oh, there. So that's where we are. That's where we disagree. Is when do they cut?
Right.
And that's okay.
Yeah, you said at one point they're not going to cut it all next year.
Yeah,
I think they start cutting by March.
Wow, by March. Okay. All right.
All right. Let me show some stuff.
Yeah.
let me show the evidence. Like we're in a courtroom.
I like it.
Hey, I saw Cocaine Bear 2 days ago.
The movie?
Yeah.
I've not seen that. Is it worth watching?
It's worth if you have an hour and 45 minutes to kill that you don't have anything else to do.
All right. Yeah.
It's interesting and kind of funny and kind of gory funny. So,
all right.
But I don't know why I mentioned that, but it was.
I don't know where that came from, but okay.
Maybe because we just came out of a bear market. Maybe that's why.
There we go. There we go. Okay.
Anyway, breakpointtrading.net. You can get my newsletter from there. Here is Stock Traders Almanac for November. We are right here. CPI comes out on the 14th. Options expiration is on the 13th. The next slide, keep that in mind. Keep those dates in mind. 14th. Actually, that's not right. This should be the 17th.
Yeah, it's the 13th day, but yeah.
13th day is actually the 17th. There we go. 17th. So keep that in mind when we look at this chart. So here we are right here. This is the cycle for the NASDAQ going back to 1971. The blue one is pre-election years, which is what we're in. You can see this downward trend from September that we went through. So far, the markets, the NASDAQ has been pretty much following along with Stock Traders Almanac, or the historical trend, let's call it.
Yeah.
It doesn't mean it always has to go that way, but this is history. And then it started up right here. And we started a little bit later than that, actually last week. And then had a huge run up, but look right here, right about the 14th. Right through this period, right? The CPI number through the options expiration.
And then we take off for the rally.
Then we take off to the end of the year. Yes.
Okay.
Exactly. So another interesting thing, I was watching a couple of channels. One was real estate related and one was stock market related. And it was before the Fed announcement. And they both did surveys. They said, what do you think the Fed is going to do? So the real estate perspective, will the Fed pause rate hikes for the remainder of 23? Real estate people said absolutely not. 66% thinks they will not pause. They'll continue going higher. The stock market guy that I watched asked, what do you think the Fed does at next week's meeting? Keep rates the same, 71% from the stock guys.
Wow, 2% thought they would cut. Oh.
Yeah, right. 2% thought they would cut.
Wow.
They're smoking something. Yeah. That must be Cocaine Bear. That's probably Cocaine Bear that did that.
So Sachs Realty is your example of your real estate content in this case?
Yes. Okay. It was a video that I watched. I watch a bunch of them. I'm not sure where it came from, but
That's right.
I
So
just thought
Sachs Realty asked a question from his audience. Will the Fed pause rate hikes for the remainder of 2023? And this would have been, I guess, the November and December raise is when this question was
yes,
asked.
this was about 2 or 3 days before the Fed meeting.
So this was really a question about will they raise in December, or sorry, November or December?
Right.
Will the Fed pause? Oh, so
Will they pause? Will they
66%,
pause?
right. So his audience, 66% of his audience thought the Fed would raise rates at least once this year.
Yes. Right.
Okay.
That's what that says.
All
Exactly.
right. Cool.
And then the stock market guy is a guy from Stock Charts that does a YouTube channel. And he asked the same question almost in real time, actually, because he asked it just before he starts his session. And then at the end, he tells you what the response
That's
was.
nice. I like that.
What do you think the Fed does at at next week's meeting, which is the one that just occurred? And 71% said keep rates the same.
Right. Okay.
27% said raise rates.
Yeah. All right.
25 basis points.
Nice. Okay.
So just interesting tidbit.
Yeah.
Kind of a dichotomy between real estate and stocks.
Yeah, that was pretty eye-opening. Yeah, real estate. Because again, in real estate, you got to remember at this time of this question, rates were hammered above 8%. We all, a lot of people in the real estate industry, which I assume is who watches Sachs Realty, probably are feeling hurt by what's going on. So
right.
I guess I get that.
Yeah, and maybe they don't see an end to it, but there's always an end. There's an end to everything.
Okay.
So let me go to my website and talk about some other things. On the homepage, I mentioned a few of these in the newsletter this week. By the way, the newsletter, you go to this homepage and just click on this button here, and the newsletter's free. You don't need a password or anything. And just click on the PDF file, and up comes the newsletter, and you can, read everything I put in. There's a lot of stuff this week. In fact, a lot of times I put in, what the sectors did and what the market did. I didn't have enough room for that. There was 19 pages I did this week.
Wow.
So I didn't really have room for the rest of it.
Okay.
But also in the newsletter is first of all, IBD changed their status.
Confirmed uptrend. Yeah.
Right. They changed 1 week earlier. It was confirmed downtrend. In 1 day, they switched from confirmed downtrend to confirmed uptrend on 11/2. This is last week's economic calendar. This is where you can see 3.9% right here unemployment rate. So 3.8 to 3.9. And next week is really nothing. Next week's a really quiet week.
Yeah.
Powell speaks on Wednesday, but there's not too much happening next week.
Yeah, the big thing on Monday that wasn't on there, at least in the real estate world, there's something on Monday called the SLOOS report, Senior Loan Officer Opinion Survey. It's going to tell us what's going on with lending. So that's really the only thing I'm looking at all week.
Right. So quiet week. So we'll see what happens with the market. So let's go look at some of the charts that I put in the newsletter just to see where they are now. First, I want to look at the high-low chart. If you remember last time I showed this, we did not have a black
I remember it was
mark up here.
Yeah.
It was all red down here. So this is the new highs minus the new lows. So number of stocks making new highs versus stocks making new lows. If it's above 0, that means there are more making new highs. It has been red for quite a while. And I mentioned then, and down here are the large cap new highs and lows, and down here are the money managers exposure. So whenever money managers are overexposed either way, so you can see the red down here and the green up here, the market usually does the opposite. Wherever money managers are overexposed. So they were all red down here. They're just starting to wake up and say, maybe we should be bullish. But this right here is, new highs are starting to come back. Here's the market. It's blew through all moving averages, which is what I said last week. I said, we've got a lot of work to do. We've got to get through the 8-day, the 200-day, the 21-day, and the 50-day before we can even get to this previous high. So that's a lot of work to do.
You did
Well,
that
we
in
got through
3
all of them.
days. In
We
3
went through
days.
all of them, right? So all we have left now is that previous high to get through. If we look at breadth analysis, this is the NDX, NASDAQ 100, New York Stock Exchange, large cap, mid cap, and even small caps.
Wow, even small caps.
Small caps are starting to catch up now.
Wow.
And we talked about this a couple of weeks ago and said, maybe the small and mid caps are leading and the large caps are going to follow. Well, it looks like the opposite. It looks like large caps are leading and mid and small are going to follow.
Interesting.
Mm-hmm. Yeah, it's interesting looking at all of these things. This is the intermarket analysis. These are the ones I watch to see if big money is rotating one way or the other. Okay. This is what I saw. The very first session that we did was December of 2021, when the market was hitting all-time highs. And I said then that this intermarket analysis was showing big money was moving out of growth and into value, even as the market was hitting highs.
I remember.
Well, as the market was hitting lows right here, they were doing the opposite. They were getting into growth.
Interesting.
NASDAQ versus S&P was going sideways, but it was not going down. Consumer discretionary versus staples did break through the bottom, but now it's coming back pretty strongly. Mid cap versus the S&P and the small cap they still have a lot of work to do. So they're trying to catch up down here.
Okay.
But this is telling me that, just like I said last week, even as the market is hitting new lows, big money is rotating into growth, preparing for a rally. That was exactly what I said 2 weeks ago.
And that's why you started dimbling, is I think the word you used last week.
Right.
Because you saw this.
That's right.
Okay.
Because this is telling me internally, big money is preparing for a rally. There's the rally. McClellan oscillator is very interesting because this is basically a moving average of the advanced decline line. This is for the New York Stock Exchange. So it's moving averages for the advanced decline line. If it's below 0, that means there are more decliners than there are advancers. And if it's above 0, that means there are more advancers. Okay. And then I color code this for when it's above and below 0.
Got it.
And here's the market right here. Here's the S&P. So I said 2 weeks ago, the S&P continues to go down, but the advancers versus decliners is going up.
Oh, divergence.
Divergence. Another sign that big money was rotating, preparing for a rally. All right. I said that way back here in beginning of October when I first noticed this. And then bullish percent index for the S&P. When it gets down below 30%, that's extremely oversold. You can see back here, extremely oversold. That was the bottom and took off from there. Very oversold here. And we're taking off from there. So this is basically reviewing all of the things that I talked about 2 weeks ago.
Yeah, can you take a quick look at the 10-year? I know it's one of these charts that you have. I just want to see how, I heard it was a 4 sigma move in the 10-year the last 3 days.
So the 10-year went from basically almost 5 or at 5 down to 4.5.
Crazy. In 3 days.
Well, it went from 4.9 to 4.5 in 3 days.
Okay.
But more importantly, it hit this resistance level up here. The moving averages, the 8-day is rolling over, crossing the 21. The 21 is starting to roll over. So this, I don't think, is done yet. It's sitting right on the 50-day right now, just from a pure technical perspective. It's sitting right on support.
Yep.
Now, it could bounce and go up a little bit more, but to me, I think this is definitely telling us it's going lower. So this could get down here to 4.3%, which is the next major resistance down here. Okay. There's the S&P right there rallying after that downtrend. This is the 2-year Treasury right here.
So let me ask you a quick question. I mean, a lot of people are talking about the reason the stock market's ripped was because bonds broke.
The yield
broke. Yeah, yield broke. Sorry. Do you see it the same way, or do you think the underlying technicals were always building and any spark could have set it off?
I think if you've been watching me here on this channel for a while, I have been saying that the underlying technicals are screaming that the market is going to rally.
Yeah, you have. Okay.
So
You just needed that spark.
So this is one of the sparks.
Got it.
There is other sparks too, like earnings is another one.
Yeah, generally better than
Right?
expected.
Yep. So I've got an earnings right here, price to earnings chart on a weekly basis. Here's the S&P up here. Here's the VIX. You can see the VIX. I'm going to show you the VIX in a second, a better view of this, but the VIX started creeping up and then it rolled over. But here's price to earnings ratio. It was below 25. Anywhere in between this range is normal.
Okay.
So it's not too expensive down here. Mm-hmm. And then earnings right here are creeping up.
Got it.
And in fact, if I go over here and look at, this is VectorVest, by the way, earnings climate. This one here goes back to December of 21. So the bright blue line is the actual earnings indicator. So it just calculates earnings over time and graphs it. The purple one is the 21-day moving average. So you can see earnings have been going down, but now it's above the 21-day. The blue one is the 50-day moving average. It's also creeping up. Here's CPI down, AAA bonds kind of moving sideways and actually rolling over, and then T-notes rolling over as well. So that shows you that earnings are moving up. Earnings are getting better. So that's another reason why the market took off. It's not only because the yield went down. That's not the only reason.
Okay, I like it.
Risk on, risk off chart. This shows you the S&P. This is bonds, stocks versus bonds. These two, blue and the green one, are interesting. This is investment grade corporate bonds versus 10-year treasuries. And last time we talked, this was starting to trend down. But since then, both of those are significantly trending up. That means risk on. And discretionary versus staples down here. That shows you that it's risk on right now. The VIX, I put this in the newsletter as well, and I actually put some lines in here. So the way I have this set up is the gray area is the actual number for the VIX. And you can see if it's above 20, bears are in control. Right. And if it's below 17, then bulls are in control. And we ended at 14, below 15, actually.
I did not realize the VIX dropped to sub 15. Wow.
Oh, yeah. So what I did was I have this on a 5-day and a 21-day exponential moving average. Exponential just means it puts more weight to the last couple of days. Right. And whenever these cross, I just pointed out that, maybe you could use this as a timing system. And when it crosses and it turns green right here, you get in. And when it crosses back and turns red, you get out, go to cash. And it turns green again, you get back in. In this case, it just went sideways. The market went sideways through this period. When it turns red, you get out. And now, right now, it's green. So right now it's telling us this is the time, actually starting last week, this is the time to be invested long in the market. Here's 50-day stocks percentage above their 50-day moving average. 2 weeks ago when we talked, it was below 20%. Yep. In fact, I think it was down around 18 or 19%. Mm-hmm. It actually got down to 10% right here, end of October. So 10% or 50 out of 500 S&P stocks were below their 50-day moving average. This is extremely oversold. These are areas, whenever this happens, it's usually when the market makes a bottom. All right, so you can see right here, you just follow that right up. That was the bottom. Okay. And for 1 week, last week with that rally, you can see what happened to both of these. Percentage of stocks above their 50 and above their 200. And there's the 10-year yield right below that. So all of this is, part of this is because of earnings. A lot of stocks had really good earnings last week, and they took off as a result. And whenever that happens, of course, people are going to buy them, and it's going to push those stocks above their 50-day moving average. Right now, it's 50%. So 250, or a little more than 250 of the 500 S&P stocks are above their 50-day moving average. another internal indicator that the market is going higher. Fed rate hikes. Right here, we've got 0, we got a plus 2.5, we got 0, 0. So depending on how you want to read this, we've got two straight months of 0 or 3 out of 4 months of 0.
Right.
So is that flat? Is that, the higher for longer? Does that start back here in June, or does it start here in September? Whatever, higher for longer. Mm-hmm. Here is the commodities. You can see oil, gasoline, CRB, these are all moving down. This is what the CPI number, part of what the CPI number will be based on, on the 14th. All right, so these are all rolling over. So I expect, and also we're going to get the basing effect for the CPI. So I think we're going to get a good CPI number. Okay. We'll see. I don't know if that's the case, but I think we will. Fed rate hikes and recessions. So here's this one back here is 2006. This is 1 year higher for longer, almost at exactly the same place we are right now. You can see this one over here where we are now is just starting to go sideways or flat, where this one here was flat for a year. And in every single case before the recession, the Fed cut rates prior to the recession. So if you think there's going to be a recession in April, that implies that the Fed is going to start cutting in February.
Yep. Okay.
Right?
Yeah. Given this logic, yeah. Given this pattern.
Yep. I mean, it doesn't always have to work out that way.
Right.
The inverted yield curve, it looked like it was heading to 0, but right. It reversed.
And then reversed.
Reversed big time last week.
Yeah, reversed pretty hard.
So that's another one. When that gets above 0, then we've got about 4 to 6 months till the recession.
Yeah.
And that hasn't happened yet. So I think the recession is probably going to be more like late Q2.
Okay.
May,
I love
June.
it. The audience loves when we disagree.
Yeah, May, June, somewhere around that time frame.
Okay.
All right. Let's take a look at the sector charts for last week. Now, 2 weeks ago, was it 2 weeks ago that I showed this? The sector was all three. No, I think I did this on Wednesday. I showed all 3 of the aggressive sectors on Friday. The Friday that was the worst day.
Yes.
Friday that was the worst day. All 3 aggressive sectors on that day were higher, were outperforming. So technology, consumer discretionary, and the NASDAQ were all outperforming the S&P on the worst day of the year. And I said right then, is this the signal? Is this what's telling us the rally is about to happen next week? And the rally did happen last week. So this is last Friday. Now look at real estate, number 1.
Wow.
That's odd because real estate is a defensive sector.
Yeah, that's got to be short covering.
That could be. Yeah, that could be. If you look at a week instead of just the 1 day, you've still got real estate outperforming.
Short covering.
Right, for the week. And you got the technology, consumer services, or communication services, and consumer discretionary, the 3 aggressive sectors, and the NASDAQ, all outperforming S&P for the week. And that's what it should look like when we have a big rally like that.
Okay.
That's the way it should look. If we go back to a month, now we can see that now we've got a mixture of aggressive and defensive. So the market in transition. Remember, this is 1 month ago. The market has been going down for what, 2.5 months? So 1 month ago, it was in transition. Were the defensive sectors going to take over and overwhelm the aggressive sectors? There's an equal smattering of both that are outperforming. But as you can see, as you move closer and closer, it's the aggressive sectors that actually were doing better. The Keltner channel just tells us how oversold or overbought we are. And last time we talked, it was way down here in the third ATI, the 3X area. And I said it rarely stays there very long. That's extremely oversold. So we got there and reversed immediately, went back to the mean in just 3 days. to the middle. And now we've blown through it to the upside.
Yeah.
So the concern here is that we are now extreme to the other end. We've still got some room to move into that 3x area, but it would not surprise me to see the market pull back for a little bit.
Okay.
And start to digest all of the gains that it had last week, which were significant gains last week. And weekly trend analysis, this shows you the long-term, medium-term, and short-term. You can see short-term, we're now bullish. Medium-term, we're still bearish, but starting to come up. Long-term, we're still bullish. And all of those pretty much look like that. And then if we look through the relative, this is what the market looks like underneath the cover. So this is the NASDAQ 100 versus the S&P, still trending higher. NASDAQ versus the S&P, trending higher. The Qs versus the SPY, you can see even as the market was selling off, Qs were still trending higher. So big money was rotating into growth. Here's XLY, discretionary versus staples. Same thing. The S&P was heading down, but XLY, the big money was rotating into discretionary, even as the market was heading lower. So all of these things were telling us that growth versus value. And down here is large cap, mid cap, and small cap is actually broke through that trend line. So small cap is still struggling.
Right.
It's still having some trouble trying to get higher. But you can see mid cap, large cap especially, are outperforming.
Awesome.
And then transportation versus the Dow, which is something that I was very concerned about and still actually concerned about, because if you look at Dow theory, usually in a healthy economy, transport stocks will outperform or at least keep even with the Dow. But they have been significantly underperforming the Dow. Yeah. That's this red line right here. So that's transports versus the Dow. If it's trending down, that means transports are underperforming.
Right.
So they have been significantly underperforming lately. And part of that, I think, is airline stocks.
Sure.
Airlines have been hit pretty hard lately. Look at that downtrend.
Oh my goodness.
For the airline, this is the big part of the transportation index. But look what happened on this is a weekly chart. So last week, with last week's rally, might have a little light at the end of the tunnel for airline. So, and trucking is the other one. Trucking also was trending down, and now it just hit this trend line and starting to move back up. So maybe transportation is going to start recovering again. So all of those things put together basically indicate to me, if I look at the S&P chart, you can see the level we need to get through is 4,400. That's where this Fibonacci level is. We've gotten through all of the other moving averages. Like I said, we needed to. And we now need to break through that 4,400 level. And if we can do that on the home page here under the S&P chart, if we can break through this 4,400 level, that will create a higher high.
Okay.
You can see the downtrend line all the way back here from July. 4,400 will put us above this previous high and will put us above this downtrend line. All right. So 4,400 is the level to watch. If we can get above that, we have a higher high, and that is the definition of an uptrend.
We're going to be paying attention. There's a lot to see. It's a very interesting time of year as well. So
yeah. So how far away are we to the all-time highs by the end of the year?
I know. What is the all-time high? Is it 4,600-ish?
4,800.
48? Oh,
yeah.
You're 15% away?
So 4,350 is what we made it, a little above 4,350, which I said last time we talked was the 50-day moving average. We had to get above that. We did.
Right. Yep.
So we've got about 450 points left.
Yeah.
To go. Now, what did we do in 1 week? How many points did we do in 1 week?
I don't know. 180.
We ended at 4,100.
Wow. 250 points.
250 in 1 week.
Yeah, that's not normal.
No, it's not normal, but it's also not out of the question that we do another 450.
Really? Oh no. Yeah. Yeah. You're not putting a time on that. Yeah. By the end of the year.
I'm saying by the end of the year.
Yeah. So
I'm going
450
out. I'm
points.
going out on a limb and saying the end of the year.
I like it. No, hey, that's a bold call, and
I
I'll
mean,
give you
it
credit.
might not be. It might be sometime in January, but I
Yeah.
think we'll be heading there. I think we're going to make a higher high here. I think we'll make a higher high here at 4,500. I think we're going to get stopped right here at 46, which is this high, and we'll move sideways. So, by the end of the year, we might be at 46, and then in January, we finally break through.
Well, one thing I know for sure is we're going to keep coming back each week and talk about what's happening in the market. We're going to look at all these charts. Show your newsletter one more time so we can start show number 2.
Yeah, breakpointtrading.net. Just go to this website, click on this button. There's no password needed. You can get the newsletter. If you want to be alerted for the newsletter, then you should register on the site. Just register your email address, and then I send an alert out each week to let people know that it's been posted. But if you don't do that, you can just come to the site and click there and read the newsletter.
There you go, folks. Breakpointtrading.net.
Yeah.
Set an alert. Check it out every, I don't know, call it Saturday afternoon, Saturday evening.
I usually have it done by, say, 1 o'clock on Eastern time on Saturday.
There you go. Well, Dan, you're amazing, bud. Thanks again.
All right. Talk to you soon.